India's capital gain tax regime has always changed with time, but over the past few weeks, the center has made drastic changes that took everyone by surprise and streamlined the capital gain tax on all debt instruments. In this video, we will decode the new capital gain tax applicable on debt mutual funds and other major investment options in India. Welcome everyone to Friday First Cut. My name is Shahnawaz and today we'll decode the tax on various investment options. There is a quote that I remember: you can escape everything in life except your debt and taxes. You have to pay tax on every kind of income or profit that you earn in India, and any income or profit that you generate on your investments is taxed under the head income from capital gain. And capital gain, to simplify, is a tax that is paid on the investments when you sell a capital asset or investments such as gold, bonds, real estate, or your equity shares. The amount of capital gain tax that you pay depends on various factors such as how long you have held the investment and your income tax bracket. And every asset class and every investment instruments are taxed differently. So let's decode the capital gain tax on your investments. Starting with first thing first, recently the center has announced that capital gains on debt mutual funds will now be taxed at investors' marginal slab rate along with gold mutual funds and international mutual funds. Earlier, if you held investments in debt mutual fund for more than 36 months, long-term capital gain was applicable, which was taxed at 20% with the benefit of indexation. And short-term capital gain was applicable if the investments in debt mutual funds were held for less than 36 months, which were taxed at the rate of investors' slab rate. Because of the benefit of indexation, debt mutual funds were the preferred choice of investors over banks' fixed deposits. And if you don't know what indexation is, so indexation is simply adjusting the cost of acquisition or your investment with the rate of inflation. For example, if your investment's return is 9% and the rate of inflation is 7%, so instead of paying capital gain tax on 9%, you have to pay capital gain tax on the 2%, which is the difference between your rate of investment and the inflation rate, making your post-tax returns on debt mutual funds higher as compared to bank fixed deposits, because bank's fixed deposits interest is taxed at investors' slab rate. But after the new rule, the tax that you will pay on return of debt mutual funds and interest on bank's fixed deposits will be similar. And despite the holding period, capital gain tax on debt mutual funds will now be taxed at investors' slab rate. Also, interest earned on fixed deposits are taxed every financial year, as compared to debt mutual funds where capital gain tax is only applicable when you withdraw the investments. Capital gains on your equity mutual funds and direct stock investments is similar. If you hold your investments in equity mutual funds and direct stock investments for more than 12 months, any gains or profits arising on your initial investments will be taxed at 10%. And a good part is that your profits up to the limit of rupees 1 lakh will be exempt from tax. On the other hand, if you held your investments in equity mutual funds or your direct stock investments for less than 12 months, then short-term capital gain will be applicable and any gain on your initial investments will be taxed at 15%. Also, it is important to note that capital gain tax will be only applicable when you withdraw your investments and book your profits. Short-term capital gain tax is applicable if the property is sold within 24 months of its purchase. The gains are added to seller's income and taxed at investor's slab rate. On the other hand, long-term capital gain tax is applicable if the property is sold after 24 months of its purchase. The gains will be taxed straight at 20% with the benefit of indexation. It is important to note that if the property is inherited, then there will be no capital gain tax liability. However, if the inherited property is sold, then capital gain tax will be applicable based on the holding period. Gold is seen as an asset for security which could be easily liquidated at the times of emergency or financial instability. But at the time of selling gold, one must keep in mind the tax implications. In particular, if you sell gold either in the form of jewelry or coins, the seller will be required to pay capital gain tax if you have made profits on selling of the gold. Short-term capital gain tax on gold is applicable if the gold is sold within 36 months of its purchase. The income or the profit will be clubbed in the seller's income and will be taxed at the marginal income tax slab rate. On the other hand, long-term capital gain on gold investments is applicable if the gold is sold after 36 months of its purchase. The gains will be taxed straight at 20% with the benefit of indexation. Knowledge of taxation is really important for making investment decisions because taxes can have a significant impact on the returns of your investments. Taxes can reduce your actual returns and thereby can reduce your overall profitability. Therefore, having a basic understanding of taxation is important to make informed investment decisions and to manage your investments effectively. It can help investors to minimize their tax liability, maximize their returns, and to avoid potential penalties and fines. Thank you so much for watching this video. For more such informative videos, subscribe to our YouTube channel.